What's up, crypto fam? Welcome back to the Crypto Breakdown Whiteboard mini-series. In today's video, I'm going to teach you guys everything about Solana, aka Sol. In part 1, I'm going to teach you guys about the Solana blockchain, TPS, scalability, validators, Solana's consensus algorithm called proof of history, and why the Solana blockchain seems to break once a week. In part 2, we're going to talk about Solana's class action lawsuit and why they are allegedly being sued for selling unregistered securities. In part 3, we're going to talk about the so-called DeFi boom and the epic growth of Solana that all could have quite possibly been one of the biggest frauds in crypto history, and how one man was able to allegedly fake $7.5 billion worth of TVL in the Solana ecosystem. In part 4, we're going to talk about validators and why Bitcoin maxis say that Solana is a VC-backed centralized version of Visa with smart contracts, and why the only thing decentralized about Solana is the word decentralized. And then in part 6, we're going to do a deep dive into tokenomics, price predictions, and how much Solana you would need to own to become a millionaire by 2025. So bust out that Jiffy Pop because we're going to go deep down this rabbit hole. And if y'all stick around to the end of the video, I'm going to teach you guys how you can enter my $500 Solana giveaway. And PS, this video is for entertainment purposes only. Nothing stated in this video is for fact. Links to all my articles and research are down below in the description. I am not a financial advisor and this video is not investing advice. So let's start with who founded Solana. Anatoly Yakovenko, the co-founder of Solana, has almost 2 decades of experience building high-performance operating systems. Anatoly Yakovenko was raised in the old Soviet Union, in part of which is now called Ukraine. Upon moving to the United States, Anatoly assisted in the establishment of the Voice over Protocol (VoIP) company when he was still in college, which gave him an impressive track record. After graduating with his bachelor's degree in computer science from the University of Illinois, he was quickly employed as an engineer by wireless service provider Qualcomm. After 12 years of climbing the corporate ladder, Anatoly was given the title of Senior Staff Engineer Manager at Qualcomm. Among his other technical achievements, he also possesses 2 patents for high-performance operating system protocols that he developed. After his career at Qualcomm ended, he was employed by D2iQ, formerly known as Mesosphere. He additionally had a brief stint as a software engineer for Dropbox, and according to this article published by Entrepreneur.com in 2022, Anatoly Yakovenko has a net worth of $200 million. Next up, we have Solana's co-founder and CTO, Greg Fitzgerald. According to Messari, Greg is the principal architect and CTO of Solana. Greg has experience in working with embedded systems. He created the bidirectional RPC bridge between C and Lua for the Brew operating system. Greg also helped launch the ARM backend for the LLVM compiler toolchain and published several open source projects, including a streaming LLVM optimizer in Haskell, license analysis tooling in Python, and reactive web framework in TypeScript. And last but not least is co-founder Ray-J Gokal, if I'm saying that right. I'm sorry if I murdered that name. Gokal is currently a board member of the Solana Foundation. According to Crunchbase, Gokal leads operation products and finance at Solana. He has spent 10 years in product management and finance. He was a venture investor at General Catalyst, started the consumer medical device company Sano, which attracted over $20 million in investments, and led project management at Omadia Health as it grew tenfold. So now let's talk about what is Solana. According to Investopedia, what is Solana? Solana is a blockchain platform that is designed to host scalable, decentralized applications. Founded in 2017, it is an open source project currently run by the Solana Foundation, which is based in Geneva, while the blockchain was built by San Francisco-based Solana Labs. Solana is much faster in terms of the number of transactions it can process and has significantly lower transaction fees than rival blockchains like Ethereum. The cryptocurrency that runs the Solana blockchain is also named Solana with the ticker symbol SOL. On December 23rd of 2020, the price of Solana was $1.09, and in less than 11 months, the price of Solana shot up by a mind-blowing 22,596%. In less than 310 days, Solana peaked and put in an all-time high of $259.97. Pretty crazy, right? Solana's market cap went from $67 million to $77.8 billion in 308 days. Talk about life-changing gains. But despite its popularity, Solana did not escape the cryptocurrency bloodbath of 2022. By June 13th of 2022, Solana's price had tanked by 87.35%, crashing down from $259 to $26.18, with a market cap low of $10.5 billion. So the next question you should be asking yourself is, how is the Solana network secured? Solana relies on a unique combination of proof of history and proof-of-stake consensus mechanisms. Solana's co-founder Anatoly Yakovenko published a white paper in November of 2017 describing the proof of history concept. Proof of history, also known as POH, is a proof of verifying order and passage of time between events, and it is used to code trustless passages of time into the ledger. In the white paper, Yakovenko notes that blockchains that were publicly available did not rely on time, with each node in the network relying on its own local clock without knowledge of any other participants' clocks in the network. The lack of a trusted source of time meant that when a message timestamp was used to accept or reject messages, there was no guarantee that every other participant in the network would make the same exact choice. Proof of history gets past this hurdle, with every node in the network able to rely on the recorded passage of time in the ledger on the trustless basis that is key to blockchain functioning. So don't quote me on this part because this is still way above my head. But from how I understand proof of history, it works like this. In normal blockchains, they have hundreds, if not thousands of validator nodes that are all storing copies of the blockchain. When validators in normal proof-of-stake blockchains are verifying a block, aka minting a new block and adding transactions to the blockchain, one validator out of the group is selected at random, and that one validator is responsible for validating that specific block. Once that validator is done, the next block is started and a new validator is selected at random. When you create a transaction, that transaction is sent to what is called a mempool. You can think of a mempool like a memory pool filled with transactions, waiting for the validators to put them into the next block. In normal proof-of-stake blockchains, only one validator can process transactions at a time, because the transactions are not timestamped before they are sent to the mempool. Transactions are timestamped by the validator as he processes the block and puts the transactions into the blockchain. So on Solana, transactions are timestamped before they are sent to the mempool. This allows any validator or multiple validators to process transactions at the same time, which is what makes Solana's blockchain so freaking fast. Any validator on the Solana blockchain can produce blocks and validate transactions. Pretty cool, right? But rumor has it, this is why the Solana blockchain keeps breaking. On paper, these new consensus algorithms sound like the holy grail, but in the real world, when you have 500 dApps built on top of a blockchain, and there's $77 billion on the line that every hacker around the world is trying to steal, things start to fall apart pretty quickly. And this is just one of many reasons why I stopped investing in proof-of-stake blockchains that have market caps over $2 billion. It almost seems to be an industry standard that anytime a proof-of-stake blockchain market cap gets above $25 billion, transaction fees start going up, the network starts to bottleneck, and network activity becomes too much for any one chain, single chain layer 1 blockchain to handle. But that's a topic for another video. If you get a chance, check out my What is the Blockchain Trilemma video. Links down in the description. It'll really blow your mind because there's only one blockchain in history that has ever actually solved the blockchain trilemma. Now let's dive deep into Solana's token allocations. According to the Tie.io, Solana's sole token distribution was as followed. Community received 38.89%, seed sale was 16.23%, founding sale 12.92%, team members 12.79%, foundation 10.46%, validator sale 5.18%, strategic sale 1.88%, and CoinList auction sale 1.64%. According to this chart by Masari, 61% of tokens were sold to VCs or given to team members. But if you notice, I did not say anything about ecosystem rewards, and that's because Solana does not have a max supply. That means every time the Solana blockchain mints a new block, the value of your Solana depreciates in value because those coins are going to validators and they are getting paid all of the newly Solana that gets released out into circulation. Proof-of-stake blockchains use validators, just like proof-of-work blockchains use miners. This is one of many reasons why proof-of-stake blockchains raise so much money and capital from VCs. Let me explain. In July of 2019, Solana validator sale took place and Solana raised $5.7 million in a Series A funding round. Solana was sold to VC investors at 22 cents per coin, if this article is correct. Now, if we swing over to Solana's website, we can see that there is no minimum requirement of Solana required to set up a validator. However, in order to participate in consensus, a vote account is required, which has a rent exempt reserve of 0.02685864 SOL. Voting also requires sending a vote transaction for each block the validator agrees with, which can cost up to 1.1 SOL per day. Now let's talk about transaction fees. When the validator is the leader, they collect 50% of the transaction fees generated by the network activity during the leader slot. The other 50% is burned. The more delegated stake you have, the more often you are the leader. It is possible to break even with a 0% commission rate from the transaction fees alone, but you would need around 500,000 to 700,000 Solana delegated to break even without any commission. Solana is unique in that voting is done on-chain and the votes themselves cost the same as the other transactions. Voting transactions end up being the primary cost of running a validator. Each epoch has 432,000 blocks which need to be voted on, and each vote transaction costs 0.000005 SOL, which ends up being about 2.16 SOL per epoch. Given that the epoch takes between 2 to 2.5 days, it costs roughly 315 SOL a year, just under 1 SOL per day to run a validator. Next up is the server cost. Server costs are the next most significant expense that you most likely will face depending on the data center you are using. Expect to spend $500 to $1,000 US per month just to run a server, unless you build your own. Now let's talk about acquiring stake through the Solana Foundation delegation program. The Solana Foundation has a delegation program that can help new validators get started. The base stake amount is 25,000 SOL that the Solana Foundation will stake within your validator. If you meet certain bonus requirements, they can increase your stake to roughly 72,000 SOL. So to sum it up, it sounds like you need somewhere between 500,000 and 700,000 Solana staked. Let's just say that we can assume that the only people running Solana validators are team members, large VCs, and centralized exchanges, which all of the above would most likely have the most delegated Solana, and they have the most retail investors staking in their pools. If the minimum amount of Solana the foundation is willing to give you to run a validator is 25,000 SOL, we can assume that probably is the minimum that anybody should have staked. That would mean that if the price of Solana today is $35, you would need $875,000 worth of Solana staked just to set up a validator, not including the $12,000 per year that you need to run a server and the extra 315 coins of SOL that you need to pay validator voting fees. I now see why people say that you need roughly $1 million just to run a Solana validator. So drop a comment below and let me know how many retail investors you think have $1 million to set up a Solana validator. And this is why proof of work maxis give proof of stake maxis such a hard time when they try to say that their blockchain is decentralized. I can go out and buy the top of the line, best of the best Bitmain KA3 miner today and start mining Kadena for $5,300. I can pay it with fiat. I don't need to buy or spend a penny on Kadena. I can buy a miner and I can earn my share of the network rewards at a very fair price. Unlike Bitcoin, where proof of work tends to become more centralized because miners tend to move into large pools, because the Kadena blockchain scales up in chains. They started with 10 blockchains, went to 20, going to 50, and then 100, then 1,000. Every time the Kadena blockchain scales up in chains, solo mining becomes more and more profitable. By the time the Kadena blockchain gets up to 1,000 chains, pool mining might not even exist. Now in proof of stake blockchains, the amount of coins that you own dictates your voting power in the network. So as we talked about before, the team and VCs were given 61% of the original pre-mined supply. That means right from the rip, no retail investor ever had a chance to get more voting power than the team and the VCs. But what about over time? Well, considering that the only people who can run validators and earn block rewards are people who own $1 million worth of Solana, I think it's a fair assumption to say that the team and VCs and exchanges are the ones making all that newly minted Solana. That doesn't sound very decentralized, does it? The whales and VCs buy massive stakes in proof of stake blockchains, they run validators, and they make insane amounts of block rewards. And this is what allows them to dump their coins on retail investors while at the same time they're shilling and pumping price. They can constantly sell the new coins they are given from the validator rewards without ever needing to sell any of their initial investment. It's freaking brilliant. I know I'm personally on a mission right now to get enough coins to run a validator in a new proof of stake ecosystem that I think is going to be the next Solana. And PS, I don't think this one's going to break every week. Now, just in case you don't understand, let me show you how much money these validators are really making. Then we're going to talk about the lawsuit, fake TVL, and make some crazy price predictions for 2025. If we swing over to Messari, we can see that Solana token distribution model on January 25th of 2021, Solana had released 0 validator rewards. As of this week, October 10th of 2022, 63,267,122 coins of Solana have been paid out to validators. So if we take the current price of Solana, which is around $35, and we times that by 63 million, we can see that Solana validators have made roughly $2,214,349,270. Pretty freaking crazy, right? $2 billion these guys made running validators, when 99% of retail investors are priced out or have no clue how to even set one up. Around November 15th, when Solana put in its all-time high at $258, validators have been paid 30,798,309 coins of Solana. $258 times 30 million equals roughly $7,945,960,722. Almost $8 billion. So Solana VCs running these validators could have dumped $8 billion worth of Solana on retail investors and still been holding on to 100% of their initial investment. But wait, it gets even better. By September 27th of 2027, Solana validators will have made over 193 million coins worth of Solana. So all the issues with the Solana blockchain revolve around proof of history, and there's one solution: make the validator requirement so massive that you would need a supercomputer to be able to validate transactions. We already know that 95% of retail investors don't care about decentralization, they only care about making money. If they did, nobody would even invest in a proof of stake blockchain. So in my personal opinion, all Solana has to do to fix their issues is centralize block production 100%. And I bet the blockchain would never break, and the Moon Boys would still be over here showing it like it's a decentralized holy grail because retail investors can stake Solana in it, or they delegate, or who knows what other goofy terms they're gonna make up. Maybe they say a DAO controls the multi-sig keys or something goofy, but you get what I'm saying. If they did that, definitely think that Solana might actually have potential to be the first layer 1 blockchain to flip Ethereum. Ethereum's market cap peaked at $575 billion in 2021. So let's just say Solana does a fraction of that and it hits a market cap of $369 billion. The price of Solana would be around $1,040. So that means that those 193 million coins of Solana that the team in VCs and exchanges are going to earn running these Solana validators would be worth a whopping $201,582,312,888. That is a lot of money on the line. If Solana gets this right, you guys realize that's an extra $201 billion. And this is why so many investors say proof of stake blockchains are like multi-level marketing pyramids. The big VCs and team members at the top of the pyramid make a large majority of the network rewards. The busier the blockchain gets, the more transactions there are, the more crypto the VCs and validators and whales make, and no matter how you look at it, there is major counterparty risk, all of which makes the blockchain very centralized in my personal opinion. Again, not fact, just my opinion. Now, personally, I don't have a problem with proof of stake blockchains, and I actually hope Solana gets everything figured out and it turns out to be one of the greatest blockchains of all time. The only problem I have with is the fact of how they market their blockchain as a decentralized, permissionless network. And the information I just shared with you took me 3 days and over 50 hours of research to compile and put together so I could present it to you in a way that it was easy for retail investors to understand. I don't think it's fair that the mainstream crypto media outlets allow this to happen. Hopefully more retail investors start to learn how this industry really works. Now, I really want to break down the entire story behind the $7.5 billion TVL fraud that happened in the Solana DeFi ecosystem, but it would take me an extra 15 minutes, so I'll just give you the gist of it. Search Solana TVL fraud $7.5 billion hoax and look for this cover photo. The video should be uploaded within 48 hours. According to this article by CoinGeek titled "Solana's DeFi ecosystem was totally fake, this is why identity matters." According to a written confession by one of the brothers behind this scheme, he and his brother spun up 11 fake developer accounts to make it look like organic development was occurring within the Solana DeFi ecosystem. In reality, all of the so-called dev accounts, complete with Twitter profiles that would interact and talk to one another, and the protocols themselves were really ran by Ian and Dylan Macalino, if I'm saying that right, from Texas. The pair coded several different DeFi protocols, linking them together in such a way that every dollar deposited would be counted multiple times, causing the apparent total value lock TVL within the ecosystem to swell dramatically. At the peak of this scheme, which represented around 75% of all TVL in the Solana DeFi ecosystem, was close to 7.5 billion. So in layman terms, and don't quote me on this, they created a DeFi protocol where you could lock up Solana and get the Saber stablecoin. You would then take your Saber stablecoin, stake it in the DeFi protocol, and you would get LP tokens. You could then take your LP tokens to another DeFi protocol and stake them and earn X token. You could then take X token and stake X token in Y protocol and earn XYLP tokens. And then you could take those XYLP tokens back to Saber protocol and stake them to earn more Saber. And don't quote me on all that, I'll explain it in more details in my next video, but you get the idea. So you would give your Solana to this anonymous developer, and he would give you this stablecoin that he just made up out of thin air. You could then take those coins, stake them to earn more coins, none of which were ever backed by anything, but because people saw these crazy high degenerate APIs, all of the DeFi degens started to ape in. In less than 6 months, the DeFi Ponzi scheme was able to add 7.5 billion in TVL to the Solana ecosystem. Pretty crazy, right? Layer 1 blockchain success is often judged by the amount of TVL in that ecosystem. 10 billion in TVL is freaking huge. It shows investors all around the world that this ecosystem can be trusted. The higher the TVL, the more likely it is that people trust that ecosystem, which signals to more investors, hey, come use Solana. Look at all these people making all this money in DeFi. Then we come to find out that around 75% of that TVL was faked. Now, let's dive into this lawsuit because this is juicy. According to this article on Forbes.com by Rosemary Miller, a class action lawsuit has been filed against Solana Labs, a for-profit company working on the development of the Solana blockchain. In a California federal court last week, they were accusing the company and people within the ecosystem of making illegal profits for promoting the Solana token as an unregistered security. If SOL is determined to be a security, it could open up many similar tokens available on prominent crypto exchanges such as Coinbase, Kraken, Binance, and others to face similar scrutiny. Ultimately, the platform could be forced to delist SOL and many other major crypto tokens. For context, Coinbase and Kraken, alongside many other platforms, delisted XRP in late 2020 when the SEC sued San Francisco-based Ripple for selling 1.3 billion of the asset to purchasers in what is called an unregistered security. The defendants listed in the suit are Solana Labs, CEO Anatoly Yakovenko, the nonprofit Solana Foundation, prominent crypto venture capital firm Multicoin Capital, CEO Kyle Semeni, and trading platform FalconX, which recently raised $150 million at an $8 billion valuation. According to this article, defendants made enormous profits through the sale of SOL securities to retail investors in the United States, which is in violation of the registration provisions of the federal and state securities laws. And to top it off, the investors have suffered enormous losses according to the lawsuit. SOL has been one of the best performing crypto assets in recent years, benefiting from the stimulus-driven market surge, as well as its top fanboy billionaire Sam Bankman-Fried, who was not mentioned in this lawsuit. The asset reached a high of almost $260 in November of 2021, but since has fallen 85%. The platform has also been plagued by repeated outages over the past few months. In the complaint, Young described Solana as a highly centralized cryptocurrency whose insiders have benefited at the expense of investors. The cornerstone of the value of SOL security is the sum of Solana Labs, Solana Foundation, and Yakovenko's management and implementations of the Solana blockchain. They created the Solana blockchain network and the SOL token securities in calculation, and likewise determined who would receive SOL securities and under what conditions, said the lawsuit. Pretty crazy, right? This is my first time reading this, but from the sounds of it, my research must have some merit if Forbes is saying Solana is very centralized and Solana was allegedly misleading investors. Pretty crazy, they're even going after the VCs on this one. Wonder why Sam Bankman-Fried's name wasn't on that list. But, you know, this is all allegedly, and I have no idea what I'm talking about half the time, so definitely do your own research. I'll definitely keep you posted if I hear anything more. Now let's talk about Solana price predictions. As of today, the Solana blockchain has released 355,284,382 coins of Solana out into circulation. The current price point of Solana is $32.50. If we take the circulating supply and we times that by the price, that gives us a market cap of $11,572,706,854. By 2025, which should be the peak of next bull run when we're looking to take profits, Solana would have released 645 million coins out into circulation. So between now and when we actually want to take profits, Solana's inflation rate is around 94.5%, and that's all going to those validators. If we take the inflated supply of 6.45 million and we divide that by the current market cap, 11.5 billion, we get a price point of $17.93. So let's make some price predictions for 2025, and I always round up to keep it simple. If you invested in Solana today, we assume that the price of Solana with inflation is really around $18, and the market cap is still 11.5 billion. For you to 2x on that investment, and for the price of Solana to hit $36, the market cap would need to be $23 billion. For you to 10x on that investment, and for the price of Solana to hit $180, the market cap would need to be $115 billion. For you to 20x on that investment, and then for the price of Solana to hit $360, the market cap would need to be $230 billion. For you to 100x on a Solana investment, and for the price of Solana to hit $1,800, the market cap would need to be $1.15 trillion. So if Solana does a 10x and hits $180, 5,555 coins of Solana would be worth $1 million. If Solana does a 20x and hits $360, 2,777 coins of Solana would be worth $1 million. If Solana does a 100x and hits $1,800, 555 coins of Solana would be worth $1 million. So if you want to learn more about the only layer 1 blockchain in crypto history that's ever actually solved the blockchain trilemma in a truly decentralized way, check out my Kadena whiteboard mini series. Links right here on the screen. So who wants to win 500 bucks? Drop a comment below and let me know what your favorite layer 1 blockchain is, and then let me know where you think the price of Solana will be at April 1st of 2024. Whoever guesses it closest to the penny and answers both questions will win $500. Again, my name's Ryan Mehta. Good vibes always, crypto fam, and I'll catch you guys in the next one.